Hi, thanks so much for joining in. You're watching the Mutual Fund Show on NDTV Profit, and my name is Alex Matthew. Like the name suggests, this show gets you updates on everything mutual fund related, and essentially it aims to give you actionable insight so that you can make your investments into mutual funds with confidence. Now, before we get started on the topic for today, I would like to give you an update. In fact, you will be able to read it on the website as well. That's ndtvprofit.com, and that is that the systematic investment plan could well be on the way towards getting smaller. Currently, the minimum threshold is 500 rupees per SIP. You might just be familiar with that. But the SEBI has been working with the mutual fund industry towards bringing it even further lower. In fact, lowering that threshold to 250 rupees. And we've actually heard from the SEBI chairperson that the SIP value is going to be reduced to 250 rupees by Aditya Birla Sun Life Mutual Fund, and it could well be followed by other mutual funds as well. So that's certainly something to look forward to. Now, today's conversation has to do with a couple of abbreviations, and it's IDCW and SWP. And if that sounds a little complicated, I won't blame you, but the reality is that it's actually quite simple. It has to do with the disbursement or the distribution of funds from investments that you make into mutual funds. There are two options available to you when you want to receive what is earned by the mutual fund that you're investing in. We'll talk about that in more detail and which situations call for which type of withdrawal. We've got Prableen Bajpai, founder of FinFix Research and Analytics, and Kshitij Mahajan, who's a managing partner and chief executive officer of Complete Circle Wealth Solution, joining me today. Thank you so much to the both of you for taking the time, and as always, it is a pleasure having you on the program. Prableen, let's start with IDCW, and the definition was changed by the SEBI from dividend to IDCW, which is income distribution cum capital withdrawal. First of all, why was that done, and what does IDCW mean?
Good afternoon, Alex, and hi to Kshitij. Yes, in April of 2021, Alex, this change was made because typically and technically speaking, there has never been a dividend in mutual funds. For example, in stocks, when a dividend is announced, it is from the profits of the company, and that is over and above whatever stock holdings the investor has. In case of mutual funds, it was always a part of the capital appreciation which was there for the investor, and I think which was misleading. So there was never a dividend. It was always distribution, but it was called the dividend option. In 2021, the nomenclature was changed, and like you said, it became the income distribution cum capital withdrawal plan. Why it was done, Alex? Many investors, mutual fund investors, I think, misunderstood that the dividend was like a bonus which was over and above the returns that they were getting from the scheme or whatever the scheme was delivering. And I think it led to confusion. It was misleading people investing in the dividend option, to get this extra bonus, what they thought is being given under this plan. And what was actually being done was that a part of your own appreciation is given back to the investors. And I'll give you an example here just to explain this. For example, an investor has about 10,000 units of a scheme, and a dividend of rupee 1 is declared. So the investor, because he has 10,000 units, 1 rupee per unit, so the investor gets about 10,000 rupees. Now, for example, the NAV of this scheme was 20 rupees. What happens is, as soon as the dividend is declared, the NAV of this scheme will fall back to 19. So that 1 rupee is actually adjusted from the appreciation which was there in the scheme, and it was never over and above. And that is why this change in nomenclature, but it is still a way to get some returns back from this scheme. And of course, there have been changes in the taxation, in how the dividends are received at the end of the investor. and there is no schedule, or there is no laid out plan that dividends will be, let's say, given every quarter or once in a year. It really depends on the scheme. It depends on the discretion of the fund house, and there is a lot of variation and variability in this whole process. But this is how the dividend plan works now, what is called as the IDCW.
And we'll talk about certain conditionalities in which situations it works in. But let's talk about, Kshitij, the other example. So let's talk about growth versus IDCW, which is what we normally talk about, right? And we're talking about income distribution. And Prableen explained it really well to say that it's a method for a regular distribution of whatever is earned by the mutual fund scheme. In the growth option, on the other hand, you have a reinvestment of the proceeds that you get, and you allow that appreciation to take place over a period of time. Could you speak to us about the pros and cons of IDCW?
Well, hi, Alex. Hi, Praveen. Always a pleasure. It's very well explained by Praveen how IDCW, or what we used to call dividend option, works. So yes, till the time you used to have your dividend proceeds, which are not taxable, or let's say we used to get some benefit of that, then it makes sense. But as we speak, I think growth option for a wide range of people is much more simpler and much more useful, because anything which you are taking as a withdrawal, and it's a combination of your principal and appreciation amount, and you have tax, which is 12.5% on a long-term side, goes on only growth option in equities. And if it's fixed income also, and you have past 2 years and you're doing, let's say, SWP or withdrawing money, it's again 12.5% now. So yes, people who are not in any tax bracket, or who are in a very low tax bracket, I think IDCW works for them. Second, IDC works for those people where you don't need a certainty of income. Because yes, you have certain schemes which are regular in paying dividends, because right now I think markets are good, and that's why you have growth coming, you have profit coming in the pool of mutual fund schemes. But that's not how it's going to remain all your investment journey. So sometime when you don't have a profit pool from where the fund manager will distribute the dividend, so at that time, I think if you need a certainty of income, then I think IDCW is not a right option. Then SWP is really a better option. And people who are in much higher tax bracket, which is more than 10%, IDCW is not friendly. As I said, because this becomes, the withdrawal becomes a part of your income, and it's been taxed, on a nominal rate of taxation on which you are paying your taxes. So at that time, I think growth option any day is a better way of looking at it. Again, if you just think that because you want to withdraw the money which has been appreciated as a part of income, then again, I don't suggest IDCW, because you are eventually, you are actually not lying, your compounding to works for you. If you have time on your side where you don't need withdrawals, and you need withdrawals over a period of time, then I think just wait for compounding to happen to your investments. And once you need the funds, go for SWP option. So these are broader places where, growth any day, has edge over IDCW. The only place where IDCW has an edge is where people who are investing and opting for IDCW, they are not falling in, or they are falling in less tax bracket or a low tax bracket. That is something where one can look at.
Yeah, that's a fair point. But the two key takeaways from what you've said and what Prableen has said is that there is no clarity on when this will be distributed. So you're waiting for the mutual fund house to decide that it will distribute. And the other aspect is the tax treatment of it, which is not really very feasible. So from that perspective, what I'm getting is that the better option to choose is the growth option in whatever you're investing in, and an SWP, which is a systematic withdrawal plan. And here we're talking about those individuals that would need regular income over a period of time. So let's lay out an example, Prableen, and then explain how SWP, or systematic withdrawal plan, works. you have invested over a period of 20 years or 25 years, and you have reached a point where you're 60, 62, you want to withdraw a certain amount of money on an ongoing basis for your regular expenditure. So you choose to do a systematic withdrawal plan. How would this work?
Right, Alex. Like Kshitij has mentioned that, it's better to invest in the growth option. And then when you want to start withdrawing, which is sort of the opposite of SIP. So all throughout our investment journey, we put in money and we are buying units. And when we want that regular money to come in, let's say in the first week of every month, we can set up a SWP, systematic withdrawal plan. And the opposite starts happening. For example, let's say at 60, I require 50,000 rupees a month. We set up an SWP, and that can be with the amount, I think, because that is, so there are different variations which are available. For example, you can even set it up as units. But if we go with more predictability, it's best to set up your SWP with a certain amount. So let's say we set it up at 50,000 a month that I have to get. So, for example, on the first time, when the withdrawal is being done, the NAV of your unit is, the scheme is about 100. So about 500 units, because you want 50,000 divided by 100. So about 500 units from your mutual fund scheme will be sold and the money will be given to you. Now, this money, Alex, which is coming to us, it'll not be just the principal or just the appreciation. It's going to be a mix of the two. Because when those certain number of units are sold, those 500 units are sold, for example, in this case, there will be some part which is appreciation. There will be some part which is coming back to you as your principal. So the taxation becomes easier because whatever is coming to you, your principal coming back to you is not taxed, only the appreciation amount is taxed. And I think with this, you can have more predictability, you have more flexibility. For example, let's say for the first 6 months, I want 50,000 every month. Maybe later I realize that, that is not what I require, and I can set it and reduce it back to, let's say, 40,000 a month. So you have the flexibility to increase, decrease, even pause it, which you will not have in case of a dividend. If you don't require dividends, you can't sort of stop those dividends from coming to your account. So I think SWP will give you the predictability. It will give you more flexibility and freedom to set up the amount that you require. What we really need to watch out for, be careful about in case of an SWP is at what pace are we withdrawing? Because that can start eroding your corpus. And that is what we plan, during your investment journey. That is how, we plan that this is the target corpus and at what withdrawal rate will you be able to, let's say, suffice for the next 30 years or 40 years of your retirement? So that's broadly how the SWP option works. But the tax treatment in this case will also depend on the scheme.
Yeah,
in case of
the asset,
debt fund.
Absolutely.
Absolutely.
And we'll talk about that. I'm glad that you pointed out at the end about how to plan this, because we lay that out as well. I have another question, which is that, Kshitij, if you are, and there's a third option, right? If you have investments in mutual funds, and if it is a growth option, you can choose to just withdraw how much ever you want on an ongoing basis. Ultimately, you're just waiting for the settlement to take place. And if we're going towards what the SEBI and the SEBI chairperson have said, is that we're moving towards a T+0 settlement. So you could well see or envision a future where you could, sell units in a mutual fund scheme and receive it on the same day. So is there a drawback to just withdrawing, or is it better between just withdrawing and using a systematic withdrawal plan, using systematic withdrawal plan instead? I think you might just be on mute.
My bad.
Yeah.
I'm sorry. Yeah, I totally agree that, just to take the discussion forward, what Praveen has said, I think there is a drawback when you just think that today I need some funds, and whenever I need the fund, I can just settle it and ask for it. Because at that day, you might end up withdrawing from one fund only. While SWP as a discipline, you can actually stagger it across funds rather than just having one fund only. So one is this. Second drawback, which is there, is that whenever you're in a need of money and need of a fund, obviously nowadays you have all these online transactions which make things and life much easy. But then that should be used as an element of top up in terms of your monthly withdrawals, rather than just the withdrawal, on the day whenever you require the fund, you should be doing. So I think as we say that, as a lump sum investment versus like withdrawal is also like lump sum versus SWP. So any day when you withdraw across schemes, the impact is much lesser. And you see some pie from some units from each scheme has been withdrawn. So not one scheme is affected. But when you withdraw per scheme, the entire funds from one scheme, I think that is when where one scheme gets affected more vis-a-vis other schemes. So I think there is a even withdrawal is what we as a house suggest that one should do. Second part, which is very relevant in this case, is that when you have a discipline, what SWP is for, that then you say, okay, fine, I have some corpus which is with me, and I want to grow this corpus, and at the same time, I want to enjoy the benefit of compoundings because I have reached that compounding part. I should do this. So and then you start withdrawing, and as and when you need some more funds, then you use this facility what you are mentioning. Otherwise, I think a stagger way of withdrawing from across a scheme or across a portfolio is a better way of doing things.
That's a fair point. Prableen, just to follow up on this, and by the way, after we're done with this conversation, we're going to take a few of the queries that have come through from some of you. And you see that number that is flashing on your screen. If you've got a specific question on mutual funds, then do write to us on that number, and we'll take it up either today or over the course of the coming few days. But Prableen, my question is that while SWP or systematic withdrawal plan is a powerful tool, is there a specific way that you envision it to be used? And let me clarify that question. Suppose you have investments in equity as well as hybrid as well as debt mutual fund schemes. Is it better to do an SWP in the debt schemes and allow the equity schemes to compound over a period of time?
Alex, ideally, this answer would depend on, what kind of a portfolio and requirement the investor has. But if we are looking at withdrawal from debt, the withdrawal rate will have to be very, very low, and the corpus will have to be very huge because we are not looking at a very high growth there. But in case of, I think hybrid becomes a good category to start investing from, or the large cap funds. And I'll give you an example here, Alex. For example, somebody is 60 today and wants to start withdrawing by 65, because it's always recommended that you invest 3 to 5 years before you start withdrawing, and let's say would live till 90 years. At 6% inflation, Alex, today expense of 1,50,000 a month will become about 2 lakhs till the time, by the time they are 60. And if they have to manage till 90, they will require a corpus of about 6 crores. So it can be a mix of different assets. We are not taking a very high withdrawal rate, but I think that having your hybrid funds and large caps can be a good option if you start withdrawing after 3 to 5 years. And your debt funds, if you haven't done that, then your debt funds can be used as a parking a place, for your initial 2 or 3 years of expenses, where you can do a SWP, but the depletion will be fast there, Alex, unless and until the corpus is really, really huge. And I think, given the fact that we have to fight inflation during our retirement as well, for example, in this case, in 5 years only, the expense has gone up by 50,000. And during the next 25 years of retirement, it would keep growing. Inflation will not spare a retiree. So I think it's best to have the hybrid component, the large cap oriented for SWPs, and have your debt funds for your contingency and other safety nets. I would like to go with that kind of strategy.
That's a fair point. And hopefully we've clarified a lot of these aspects. Now, let's jump into the queries. And we've got a question from Adarsh. And he's asking, he wants to invest 1 lakh per month over the next 3 years. And he's particularly looking at the ICICI Prudential mutual fund schemes. He's 33 years old. I'm guessing he's talking about equity mutual fund schemes. And I'm guessing Kshitij S. Naren will be quite happy to hear about this, because he seemed to have made an impact with Adarsh at least. While you're answering this, could you also talk about the kind of style that is employed by this fund house?
So I'm sure ICICI guys have been doing a great job. But at the same time, one need to understand, and you answered half of it, that you should participate in different styles. You should participate with different houses. And I'm not asking you to do 10 mutual fund, but at least have 4 to 5 different styles which are there. Broadly, Naren style is more of a value style. They do have fund managers which are on the growth style, and they are now working on, many of the schemes are working on factor investing also on the index side. But in a nutshell, I would like to say that ICICI is a great house. You should maybe pick a couple of schemes from there. At the same time, just add different styles of growth, and as well as factor investing. There are certain good fund houses, others than ICICI also, which you should include. Maybe a contrarian strategy in your portfolio, and make a good portfolio of a flexi cap, multi cap, momentum large cap, and larger mid cap style. If you're a little others, if you have risk appetite which is on a higher side, you can look at adding one sectoral bet. For sure, not defense, not PSU, and not any railway bet, but yes, you can look at manufacturing or maybe a banking. I like these two sectors. That's my personal view. You can do your research. There's no recommendation here. So I think these are the
to that end, not a recommendation, but just having looked at these schemes for so many years, which out of the stable of ICICI Prudential mutual fund schemes, equity or otherwise, do you like?
I like India Opportunity a lot. That's been managed by Naveen himself. Their value discovery is their flagship, but I like India Opportunity a lot. It's a value theme, but they have a good mix of some growth stocks also. Many of the growth stocks are now value stocks on a light note, like HDFC Banks of the world. They become like a value stocks as we speak. But I like this scheme a lot. Their India Opportunity.
Okay, here's an interesting question, and Jay's got this question. He's talking about a loan against a mutual fund, and he's considering utilizing his mutual fund units as collateral in order to take a loan of 1 crore. And this is after a property deal fell through, he points out. He's 43 years old. Is this a good idea in the current market? And also, should he consider, who should he consult? He's asking about this. But Prableen, I will take this question to you. On the first question, what should you bear in mind in such a situation?
Investing with borrowed money is not a great idea, Alex. So I would, upfront discourage Jay from doing that. He's saying that, the land deal didn't go through or the property deal didn't go through. But perhaps if it is on the cards and, in the next year or 2 years, again, he would be requiring the loan amount that he has taken, then it's best not to invest this money in the markets. Or even if he's investing, for example, that should be in a very safer kind of a low risk fund. That would be my advice. And given that, he's still thinking whether he has to go between an RIA or a mutual fund distributor, I'm not even sure whether he has a portfolio which is already there. Perhaps he shouldn't have been asking this if he has a portfolio. But I think he should go to an advisor if he knows a good distributor who is knowledgeable about the markets. Then, I think either ways, if you're doing a good job, I don't think that the designation here really matters. But I feel that his question appears that he is not very experienced in the industry itself currently, and I would say that he shouldn't take the risk of investing with
no, absolutely, money. Prableen. In fact, I misread the question. I thought he was talking about a loan against mutual fund units, but he's actually talking about investing a loan of 1 crore. Please, I mean, Jay, I can answer that. Please don't do that. Don't borrow and invest. That's not the right way to do things. Digvijay is asking this next question. He's 29 years old and he's saying that he's investing 15,000 rupees per month across 3 funds. He's asking whether he should add another fund to achieve a target of 4 crore by the time he turns 50. Kshitij, you've kind of answered this question already. To have a pretty diversified investment portfolio, he's investing in Canara Robeco small cap, he's investing in Kotak Equity Opportunity and UTI Nifty 50 Index Fund, which is actually quite a nice mix. Would you suggest that he should add something more to this?
Maybe maybe one fund he should add. It's already well diversified. 3 funds are there. Maybe one house on a multi-cap side, he can just pick. There are good multi-cap funds across schemes, and he can just pick one multi-cap fund, which will give him a fair participation of mid and small cap, because any multi-cap fund needs to have at least 25% allocation toward large, mid, and small. That's why the functionality of the scheme they have to maintain. So he'll get some exposure on that side also. So and at the same time, my request to him and anyone who's investing into, like you keep on stepping up your expenses, one should keep on stepping up their investments also. So I think the difference of SIP versus step up SIP is huge. So if as and when you have some increments coming your way, if you're working, your salary increments, if you are in business, whenever business is doing good, just keep on stepping up your SIP and keep adding to this flavor, because compounding really works, and it's a magic. If you see after 15, 20 years, sometimes you see 5, 6, 7 years, 10 years, nothing happened, but that's not the time frame which you should look at. You should look at a broader time frame, and you see how money multiplies.
Yeah, that's a very important point that you've raised. The next question that we're taking is from Rahul Surana, who says that he's 44 years old. And I was just doing a quick back of the envelope calculation. He's investing 5 lakh rupees, and this is a lump sum. He has invested in the Motilal Oswal Defence Index Fund. He's asking, should he hold on to this? His goal is to build a corpus of 8 to 10 lakhs in the next 5 years. The back of the envelope calculation, Prableen, that I was doing is that if he wants to reach 10 lakh in 5 years, he would have to do about 14% or thereabouts per year. You know, the question is, does he do this in one particular scheme, and this is a sectoral scheme, or should he split it into other investments as well?
He's already done it, Alex. It seems he says he's invested, and of course he's chased the returns. So, like you said, 72 by 5 and 14% returns is what is needed to get him 10 lakhs. But I can give him an estimate on, where he can be. So, for example, he's just getting, lesser returns of about, let's say, 11 to 12%. Then he would be around 8 lakhs. And if he's able to get higher, of course, he achieves his goal. But the strategy is not great, Alex, because, he's invested probably looking at the returns of the HDFC fund, which was launched much earlier. This sector is already run up so much. How much will it go, or will it really deliver the CAGR 14% in the next 5 years is nobody's guess. But as a strategy, it's not great to invest in a thematic fund hoping for it to sort of double in a certain time period. So if he gets a chance, maybe a year later, if he's in, profits, partially redeem, and then 5-year investment with a thematic fund is as it is risky. So he should diversify, like you mentioned, that, allocation in one fund is not a great idea. But it's so difficult to give him, prediction on whether he can achieve or not. But yes, a 14% return is what can get him there.
Yeah, all right. Prableen, as well as Kshitij, thanks so much for joining in and for answering all the questions you did, and for the insightful conversation that we had at the start. That brings us to the end of this particular edition of the Mutual Fund Show. It's been an absolute pleasure bringing it to you. Do stay tuned, lots more coming up over the course of the day. And this is NDTV Profit.